This Twin Peaks Investing podcast is brought to you in association with SharePad from ShareScope, the UK's #1 investment data and analysis software for private investors and traders. Visit sharescope.co.uk and discover the advantage.
Hello and welcome to the Twin Peaks Investing podcast. My name is Peter Higgins and this is podcast number 90. Yes, folks, we've been around that long and we're here today, but unfortunately we have not got Wheelie Dealer. I'm sure a few of you guys, ladies and gents that follow him on Twitter, I've seen some of the news that we've had, and he's been a bit poorly of late. And he was in A&E on Sunday for a ridiculous amount of time and got very little help and support. So he's not going to be on this podcast today, but I'm very, very lucky to have Simon Cooper, that many people know as brilliant leader on Twitter. Hi, Simon, how are you?
Yeah, hi, Peter. Good to be here. Could have been under different circumstances though, so hopefully let's send our best wishes to Pete. Hope you get better soon, Pete. Sorry to hear of your problems.
Yeah. Absolutely. I mean, I spoke to Willie on Sunday via text, and I spoke to him last night on the phone properly, and he was like, "Oh, the show must go on. We've got to get somebody in. Blah 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 blah." Hence, I contacted you and got you on the show. We were recording this on Tuesday, ladies and gents. It's the 13th, ahead of time, because this is the only time I could get Simon on. And Simon's been listening to this podcast for a little while now, and it was great. It's great to have him on. But I spoke to Wheelie about this, and you and I have had a chat, Simon, about it as well. And it's this thing about the NHS. What do we do with it? What can be done with it? How can we improve it? There are so many people in need, and the waiting list seems to be getting bigger and bigger. And when someone goes into A&E now, you could be there for an indeterminate amount of time before you get supported and helped. Any thoughts?
Well, it's a can of worms, isn't it? I'm afraid it's my own view is that there's a lot of inefficiency in the NHS, but there's also challenges that they're facing that. Well, you were saying trouble getting the staff is a challenge, it seems. I'm not really sure what the issues are, but I just hear increasingly people having to wait an inordinate amount of time at A&E, waiting lists getting longer, a real worry with ambulances not coming very quickly. So there's clearly issues right now with the health service. But it's above my pay grade to know what the answers are. I mean, someone really needs to, it needs some sort of reorganization, doesn't it? Replanning in some way, because you can't just keep throwing more and more money at it. That's not the answer. It needs joined up thinking really across the whole thing, including care in the community, etc., etc.
Agreed. Now, what I'm going to do with this particular podcast with you, Simon, is I'm going to quickly talk about the markets, yeah, and then we're going to fully introduce you to our lovely audience that are around the world, and then we're going to get into what makes you tick regarding your investing. So, touch on a little bit about your previous career, if you can be kind enough to share how you started and why you started investing, and we're going to also give you the opportunity to talk about, I think there's 2 little babbies, grandchildren that keep you fit and active.
Yeah, absolutely. Yeah, don't they ever? Yeah. Two young boys that we have at least 2 days a week here. So we have them sort of while the parents are working, basically, and it's a joy, but you're very glad to hand them back at the end of the day.
Happy grandparents, but happy to give them back. Yeah, absolutely.
Yeah, that's I mean, people. I've heard people talk about how brilliant grandchildren are before, and I didn't really appreciate it until we had them. We're very lucky to live around the corner from them, so like I say, we have them 2, maybe 3 days a week, and it's tremendous fun. It's wonderful. But the best bit is being able to give them back at the end as well. It's like, right, now we can have a glass of wine and put our feet up.
Absolutely, reward yourselves. Absolutely. Oh dear. Right. So since the last podcast, ladies and gents, the markets have ebbed and flowed. We were touched 7,460. The markets are now poised for a Santa rally, which will be officially in about a week and a half's time. So we should, whether we see it or not, it runs into January. I don't know. Yesterday, the markets, the FTSE 100 index closed down 0.4% at 7,445. The FTSE ended up down 0.5%, 96 points down at 18,819. And the AIM closed down 0.5% at 830. And today, it's just flattish, really, as before we started. FTSE was at 7,450 and AIM was at 829, so not much movement. And we've got some news due today, so we'll see how the markets react to that. How have you been following the markets, Simon? In the sense of, it's been one of those years where there's been lots of noise, lots of volatility. The small cap space has been all over the place. What are your thoughts about it all?
Oh, well, it's been a really tough year. It's if you're an investor in UK small and mid caps, which I am, it's been a horrible place to be. I mean, they've completely fallen out of favor earlier in the year. I mean, it was starting anyway, I think, in the first quarter, but then the Ukraine invasion, which is, still an ongoing problem for all of us. That's well, people just ran for cover, I think. So I think small caps were just the wrong place to be, small and mid caps. I'm not sure there was any good place to be, really. The FTSE 100 sort of did okay. The US wasn't a good place. I mean, it was, for me, the dollar strength is what has really been killing everything this year. So there were probably some good trades to be had. But yeah, so it's been a tough year. And then we had a moment, didn't we, with the Truss government and all of the shenanigans around, her policy that she wanted to bring in, which actually I thought had some merits, but it was the right policy at the wrong time. And obviously we saw the market's reaction to that. My own view is that we pretty much got a capitulation in the UK that over that period, over that 2-week period. That really felt like capitulation to me. And well, I'll tell you a bit more as we go on, but I mean, I basically liquidated quite a few of my investment trust holdings, and I essentially bought my watch list and bought more of what I already own, and I bought my watch list because I just thought this is crazy. This feels like the prices now that everyone there is no one is buying, and I think I got some real bargains, but we'll see as time goes on. That said, I think since they sorted it out, since Truss went and whatever we've got now, the markets have settled. I think the UK has become investable again. We've probably got recession to come, but we don't know how long that's going to run. So a lot of it is now all about the US. I don't think the US has had a capitulation moment yet, and when they do, inevitably these things will always be some sort of liquidity moment when people are either running for cover or getting margin calls all over the place. But I think we'll get some aftershocks from that, for sure, because it won't, when they sneeze, we catch a cold. But I think we have had our capitulation moment. I think everyone was selling UK stuff that during that fortnight. And I think next time round, well, that's my own view, is that it just doesn't feel like we're ready for another full-on bull market yet until the US has had its capitulation moment, which I don't think it has, but who knows? I mean, I'm no macroeconomist and so on. I think the shorter term, you're talking about the Santa rally. Have we got the CPI print today coming from the US, and then the Fed?
Yes,
we got
do.
Fed decision tomorrow.
This afternoon.
I think Europe and the UK on Thursday. So I think whether we get a Santa rally probably depends on those three events, and mainly US interest rates. And so, whether
it's
we get a Santa
very hairy
rally.
when you see that the Dow Jones moving 1,000 points on it, like you're like, what just happened? You know, it's so volatile when they come out with that print, and then you get the sentiment regarding our interest rate's going to be increasing even further here. You know, blah blah blah. Oh, you know, and then the markets settle in the last hour, either up or down, and then you know what's going to happen for the next week or so regarding the markets. So yeah, it's a massive sentiment thing. I think you make a great point regarding trustonomics, which what everyone was talking about, you know, back in August, September, October time, and it not quite being the right time for it. And you know, we've got Jeremy Hunt now and Rishi Sunak with a slightly different take on that. And the market seems to be relieved that things aren't as bad as they could have been. I'm certain going forward that they're going to question some of the moves that are forthcoming next year. I don't think we've had the full weight of what Jeremy Hunt and Sunak are planning. So we will see. I agree with you in the respect regarding the capitulation that we had when we hit 6,800. I actually felt it was going to go below that even further. And since then it's rallied and it hit almost 7,600, and we're sitting here at 7,450. So if we can hold on to the majority of that by the 31st of December, I think that would have been a result for the FTSE 100, to be fair, and it would have outperformed the vast majority of other markets. You know, so that's not bad. I mean, the small cap space has, as you said, have not done well. FTSE 100 has held up because if there's one place to have been, it was blue chips potentially, or certain blue chips, especially oilers.
Yeah, I think that the makeup of the FTSE 100 index. I mean, to be honest, I had, if you'd asked me at the beginning, what's the level of FTSE 100 at the moment, I'd have no idea, because it's not an index that I follow particularly closely. But, you know, the makeup is not the type of company that I generally go for. So there's a lot of sort of miners, commodities, oil, obviously BP, Shell head that index. You've got a couple of other big names, GSK, AstraZeneca, and then the banks. But all that, I mean, banks, insurance, commodities, just stuff that I'm not generally interested in. And so I virtually never find myself fishing in the FTSE 100 pond. So yeah, I thought the real issue around the trustonomics was the gilt market. That was the reaction that caused the capitulation. Gilts were getting super expensive, and I spent most of that week when it was happening, first of all trying to get my head around what was happening with the gilt market and how far that would go, and then I thought, well, time to get on with my knitting. I've got a lot of companies here that are getting very cheap, so I was quite an aggressive buyer in late September and early October. For sort of the last 2 weeks of September and the first 2 of October, I made, well, I offload. I was holding quite a few REITs and infrastructure trusts, particularly renewable infrastructure trusts, and they were lovely. You know, they worked all year really well. They were pretty much in positive territory, all of them, over the year, or most of them, maybe not the REITs so much, but the infrastructure trusts. They were paying sort of 6, 7, 8% dividends, so it's very nice. Quite a good way to sit out the market turmoil. And then they got hammered in that period. That when gilts went racing up, they become much less attractive. If you're getting 5%, 5.5% so-called risk-free with gilts, 6-7% with risk doesn't look so attractive, and that's really the investment case for those. Plus the fact they all went to discounts, and raising more funds was going to be challenging. So you've seen, like with Digital 19, for example, was one that I held, and the investment team left because they weren't going to be able to invest in any new opportunities. So at some point during that period, I more or less cut my losses with that whole infrastructure REIT space, to provide liquidity to buy small and mid caps, including pretty much everything that I already owned in that space, and sort of 6-7 more new entrants, which at the time felt like a bold move, but it felt like the moment. And since then, a lot of them have rallied sort of 20-30%. So but it wasn't a short-term move. It just felt like if this is the time to buy what I would call quality compounders, companies that, I'm not looking for companies that are going to shoot the lights out. I'm looking for companies that are going to repeat growth year on year, because they're making money that they can reinvest in growing the business. And quality at the right price. Well, what happened in late September, early October for me was that the prices got really good. Some of them were just too cheap, and I got aggressive. Now we've got to wait a year, 2-3 years to see whether that was the right move, but we'll see. I'm very optimistic actually about what I've bought. Well, 2 of them have been taken over already.
So, we'll talk about them in a little bit. Yeah.
Two of them, two that I bought during that period have been taken over already, or the subject to takeover activity, shall we say.
Brilliant.
So that's how I sort of the lens I'm looking through. And then on the macro front, I do pay attention to macro factors because it gives us the context. It helps us to understand why people are avoiding the UK, or why people are avoiding small caps, or why commodities are the right place to be at any particular time. So I do pay attention to it. But during the course of this year, I found it to become too much of a distraction. So I've really, in the last couple of months, I've really wound it back to focus on my knitting and focus on researching companies that are in my pond, and there aren't many. I've got about 8 screens that I use, Peter, to source ideas, and when I look through those screens, there's my preferred screen has only a dozen companies on it. So there's quite a lot that just doesn't come into my universe at all. So I'm quite narrow when it comes to my investment focus. It's diversified, but narrow in terms of I know what I like, and I try to stick to. And when I do stick to that, I tend to do all right. So
it's about being disciplined. Now, you've said some really significant and interesting things there, which I want to go back to. But first, I want to just get people to understand and get a bit of clarity on when you started investing and why. And then we're going to unpick some of the things that you've just said and talk about some of the quality metrics that you're looking for, and also the point that you said about macro being a distraction as well later on. So to start with, when you started and why into investing, and let's get to, because I think that gives an understanding for anyone listening why you're doing what you're doing now, being opportunistic. You saw those being sold off, you're like, well, what's going on here? This watch list now is now sitting there going, screaming, buy. So give us a bit of flavor about when you started, why you started, what was your learnings, what you read, what makes you the brilliant leader that you are now with investing?
Well, first of all, brilliant leader has got nothing to do with investing. That's to do with my career before I retired.
It was a bit about your career as well. Yeah, go for it.
Yeah. So I started investing in 1997. I remember that because of other things going on in my life, and I had a bit of spare capital, not a huge amount, but I thought, oh, I'll give this investing lark a go. And I read Jim Slater's Zulu Principle, and then I read it again and started to understand it. And at the time, I didn't have the internet was just coming in then, really, for mainstream use. But I wasn't really using the internet. I was buying the FT at the weekend. I was looking at PE ratios, PEG ratios, just from the FT, and trying to follow the Zulu principles. I think my earliest investments were JJB Sports, if anyone remembers that, which did rather well.
Yes.
And NatWest, before it went off the market and came back again. It was one of my. And then I got caught up, and then I sort of joined the Motley Fool. I found the Motley Fool.
Okay.
I was, on the internet. I was starting to use the internet. I found the message boards on there and what seemed like some really smart investors and a lot of noise. It's like Twitter was a couple of years ago, I suppose. And it's harder to manage the noise than it is on Twitter. So I got caught up in the whole .com boom, and I made a lot of money. That capital grew significantly during that period. And then, unfortunately, I also got caught up in the .com bust. And I mean, I spent some years in the wilderness. I would say 2000 to 2003. I was still caught in the old paradigm. I was still trying to find multi-baggers as per .com days, because I'd had something like 6 or 7 10-baggers in a year.
Wow.
I mean, it was crazy times, and I was. People were avoiding old economy stocks and anything that was internet related. It was just crazy. But I gave it all back again because I was still chasing that old paradigm of trying to find multi-baggers, whereas actually the smart move was to buy value at that point, and probably large cap value. Although I remember coming out of that period, and Paul Scott, who writes the SCVR now on Stockopedia, he had his own bulletin board on the Motley Fool, and he was buying companies that were trading for less than cash and becoming a shareholder activist and so on. So I had a little bit of that, and that sort of got me back to analyzing companies properly. And then then we go through. I missed the great financial crisis in 2000. So between 2003 2007, I started to get better as an investor. I started to learn how to invest, I would say, during that period. In 2007, I took a lot of money out of the market, most of my money out of the market, in fact, at the time. For personal reasons. My mother had been diagnosed with Alzheimer's, and I wanted to move her close to me so that we could look after her. So we took the money out to buy a house for her, basically. And so the whole I only had maybe I kept about 4 or 5 holdings at that time, and I pretty much didn't look at those holdings during 2008. So I just waited until I came back into the market. So I was out probably until about 2011 before I had meaningful capital coming back in again. And then since 2011, I've been continuously in the markets. The only time I stepped out of the market was just before the Brexit vote, because I really didn't know what the vote would be. It was clear that it was going to be a close call, and I I wasn't smart enough to know what the real impact would be of a vote in either direction. So I got a bit nervous there. I was about the most I've been in cash since 2011. So I was about 40% in cash at that point. And I was quick to get back in after the Brexit vote. I say quick. It took me a week or two to work out what the moves were, but it was the pound that was getting hammered. So and particularly against the dollar. So I bought quite a lot of net dollar earners in that period. Still quality compounders, but I was almost eliminating stuff that was UK focused at that point. And since then I've been fully invested pretty much. COVID, I did sell stuff during COVID, but I was also buying quite aggressively in that period. So it's volatility, isn't it? It's all I mean, when there is a sell-off, that is the time to buy. You just got to make sure you have the liquidity to buy. Some people do that by sitting in cash. I mean, some people were in cash going into this year. People that I follow on Twitter anyway, a lot of people were going into cash the back end of last year. I think more people went to cash earlier on in the year, and that, as I've said on my blog, I think that maybe it's a smart move, but I can't do it. I can't sit with 60% of my portfolio in cash for 9 months. Like I said, I would struggle to get back into the market because you're absolutely at that point needing to time the markets. You've got to time. It's not just timing your exit, but timing your re-entry. So I took the view, after that Brexit situation, I lost quite a lot of dividend income during that period, and it was noticeable. It was only a quarter's worth of dividend income, but I noticed it, and I just decided at that point that once I'm going to stay in the market all the time, as much as possible. So unless I get something really scares me, I'm a fully invested person, and I don't try to time the market per se. I try to focus on achieving my objectives and taking it. When there are big sell-offs, I try to buy. I try to be a buyer in the big sell-offs. So maintaining watch lists is really important, so that you're you know what to buy when the time comes.
Okie dokie. But firstly, kudos for sorting your mum out and buying the property and liquidating your portfolio to an extent to look after her. I think that's fantastic that you did that. I think what's important here, a few things that you've said here, is that the changes in your strategies over the years, in a sense of, I don't know, I don't think I've ever spoken to anybody that hadn't got involved in the dot-com boom and then the dot-com bust. I think that's where a lot of us older ones got involved a lot into the market. And multi-baggers, this, you only have to say, oh, this company has now got a .com to its name, or it's added a website. I remember some people seeing share prices gone because they'd added a website. Before they didn't have a website. I was like, wow. It was ridiculous. I think one of them was, remember Fives added something or other to the banana people, and they added some, and the share price went whoosh, and I was like, this is madness.
Well, it was
amazing.
I was mixing with a few city people at that time, and people that worked in investment banks and brokers and the like, and the big thing going around was, do they have an internet strategy? So all of the old economy, all of the existing companies that were making profits and good companies,
that actually made money, absolutely.
They were all being challenged about whether they had an internet strategy. So there was a scramble in that, for companies to come up with just creating a website so that they could say that they had an internet strategy. And like you say, when they did, then they tended to get a positive market reaction. But of course, we were all, a fair way off the mark, because, it wasn't it wasn't as simple as having a website. I mean, actually having a
More
proper
than that.
internet strategy. It's something I still look at, actually. You know, what is the strategy? And we're looking at, you know, whether you've got a platform, whether you've got an online strategy, whether whether you're selling your product online. So for me, this is an ongoing thing still about looking at people's go-to-market strategy. And a lot of them are still, you know, they fall short on that sometimes in my book.
This is a quick hello to you, our valued Twin Peaks Investing podcast listener. Whatever channel you're listening to, please make sure to subscribe and you'll always be the first to get the new episodes. Thank you for your continued support.
Absolutely. Now, what I want to talk to you about, this term that you use, I love the term that you've used, quality compounders, Simon. So
Yes.
What, in your eyes, is a quality compounder? You've gone from the tech stuff in the 2000s, where it just needed to have an internet strategy and it went whoosh. Now, you, me, and everyone else is looking for the stocks that can return a good percentage of total returns on an annual basis or a long-term basis, you know, and are going to be we consider them that they're going to be around for the next 5, 10, 15 years, not you know, like a lot of the IPOs that have happened in the last 2 or 3 years they've come and some of them have already gone.
Yeah.
So what to use a quality compound, and give some examples of what you've got in your portfolio as well, if you'd be so kind.
Yeah. Okay. So I've been working on a checklist actually in the last couple of months, trying to identify exactly what I do mean by a quality compounder and what I'm looking for in a quality compounder. So maybe it's easier if I just walk you through. I did post it on Twitter actually in a conversation with James, who a previous guest of yours.
Yes, yeah, excellent. Yeah,
and I did share it, and we had a bit of a conversation about it because it's pretty good for this type of company, I think. So. So this particular checklist that I have has the following components. So it's got, I look for a return on capital employed over a 5-year average of above 15%, a return on equity over a 5-year average over 15%. So I think when you talk about quality compounders, those are the two key starting points for me anyway, because that they are companies that over the last 5 years have compounded returns by, you know, above a certain figure, and 15% is the watermark that I've put in. I also look at cash return on invested capital in the last year, just to make sure that they are turning their investments into cash. I mean, it's quite an interesting one when you take that out, but I've set that at 15% as well. Gross margin above 20% and operating margin above 10%, again on 5-year averages. So I'm not a fan of wafer thin margins. When I see operating margins of 2-3%, and I ask myself what could go wrong, well, they could slip into loss-making situations very quickly. So for me,
it's been the worst.
Yeah, well, yeah, I mean, they are. Well, they're just uninvestable from my point of view. So that operating margin, I think, gives a degree of safety in what you're holding, that you're unlikely to be buying something, unless it's a fraud, that's going to go bust. Net gearing, less than 30%. And most of mine actually are negative gearing. Most of mine are cash-rich balance sheets, but I'm happy to take companies with some debt, as long as I understand why they've got the debt and what it's about, and that it's manageable. So when a company has got debt, I'm checking things like interest cover and so on as well.
Evidence,
yeah. Then a dividend yield above 1%. I just, every single company in my portfolio pays a dividend, even if it's a small one. I like to see a cash return from it. That's probably a personal bias that stops me getting into 1 or 2 opportunities. But hey, And then earnings yield above 5%. These are more valuation things now. Earnings yield above 5%. EV to EBITDA below 20. Now, I'm not a fan of EBITDA, but EV to EBITDA is how a lot of companies get valued in takeover situations, particularly around PE takeovers. So I'm looking at that below 20 because then you can see that other companies might be interested in buying them if they've got some of these larger companies, if they've got an EV to EBITDA above 20, then buying something with a lower EV to EBITDA ratio it immediately looks like good business for them on their because the earning multiple for them is higher. I also have price to operating cash flow below 20 as part of the screen, and I'm not a fan of PE. I don't know what the PE is half the time. It's one of the things I look at least because I think earnings can be massaged, shall we say, with adjustments and the like. But cash is much harder to massage. So, and I do look at free cash flow, but free cash flow can be influenced by things other than operational trading. So I find operating cash flow is a measure that I particularly like. And then I'm looking at whether there's an EPS growth for the next year forecast. So have we got forecast growth? Ideally, we want a quality company. You can have quality, but if they're not growing, then that can become a bit of a trap. So with quality, quite a key component is you want some growth. Some of my older holdings, I'll give them something like, for example, Games Workshop. If you look at their forecast, they're not forecast to grow. I think their forecasts are normally conservative anyway, but putting that aside, I tend to look at something like that over, say, a 3-year cycle rather than just the current year. But generally speaking, when I'm taking on a new holding, I am looking to see, are they expected to grow in the current year or in the year ahead. And then the other thing I still, harking back to my Slater roots of the Zulu principle, I like to have a peg in there. I am interested in companies that have a peg below 1 because that can often mean that there's a particular opportunity at the moment. But on my screen I set the peg at 2 because I just so that's my screen. It's a screen and a checklist, and so the first thing I do when I spot a new opportunity or a potential opportunity, someone mentions it on Twitter, someone mentions it on Stockopedia, or if I on a SharePad article that I pick up, or anywhere, on a bulletin board somewhere, the first thing I do is I put the ticker into my checklist and I see where it hits and misses, and at that point I can move on. 9 times out of 10, it might be an interesting opportunity, but it's not for me. It's not the style that I'm that's quite a stringent set of criteria that I've just listed there, and not many companies make the cut, but the ones that do, I get really interested in. So then I'm into getting under the bonnet, reading the company reports, etc.
I think it's important to have your own structure. This is what I keep saying to lots of people that will listen, is that you've got to find your own way, and even if people make suggestions, they've got to meet your criteria and your discipline and your structure, because otherwise you're just blindly following, and you don't know what you've bought. If you don't know what you own, as soon as there's a bit of a movement, you go and you're out of it, but you don't know the reasons why the share has moved. So I think it's brilliant that you've developed and keep refining this strategy going forward, Simon. And you've mentioned quite a few things here that are really important that people need to really go back and have a look at, and that's net gearing, cash, the returns, the margins, and all the rest of it. With these speculative stocks going back to the dot-com era, none of them would have met any of those criteria. You know what I mean?
Because they were all pre-profit.
They're all pre-profit. Yeah, absolutely. And the beauty of now is that you've got a smaller and smaller and smaller universe of stocks that will have a far better chance of being around 5, 10, 15 years from now. So you're actually pushing your portfolio further and further up the quality, value, real, fantastic companies sort of cohort. And I think what unfortunately happens sometimes is people just see a name, they see who's talking about it, or it's been mentioned by Stockopedia, or it's been mentioned in that ShareScope article, and that's all they need. And actually what you're saying is that it might be a good writer, it might be a good person that's written about it, but does it meet my criteria? Let me put it through my filters. That one does, that 1 out of 10. Let me go and dig deeper even further now and see if there's anything else I need to know about that company. So I think it's really, really good that you've done that.
I should emphasize that it's not a pass or foul in the sense that, I mean, the actual criteria, I think there's 12 key criteria there. If a company's only past 10, I'm still going to have a closer look at that company, depending on what the 10 are.
Absolutely.
Yeah, so I'm not looking. I'm not just keeping it to 100% pass against the checklist. It's just what it tells me, actually, Peter, as well, is that if it's a miss on an item or a couple of items on the checklist, it highlights what I should be looking at. I go and look at those items to see, what. Oh, this one didn't return 15% cash last year on its invested capital. Well, why not? Was it a one-off year? What's it look like over a longer period, and etc. So it helps me to focus on the things that I really want to have answers to with that company.
Brilliant. You touched on PEG as well, and you also said not a fan of PE, and PE can be massaged, and which we're seeing now. Every day now, the main RNSs you're seeing is buying back of shares. What's that about? Massaging of numbers, obviously, so the bosses can, and the boards can actually meet their targets for their bonuses and so on and so forth. Lots of going on, and sometimes it's a sign that actually the board and the CEO, CFOs have run out of ideas. Let's just buy back shares. So PEG, you mentioned that you'd like less than 1, but you actually put the criteria to 2. Why is that, Simon?
If you don't like PE, you shouldn't really like PEG.
I was trying to be subtle.
So I don't. In fact, actually, at the moment, I've got it switched off. So I was running it with James, and I had it switched on, and there were 9 companies that passed, and then I switched it off because sometimes anyway, it took it up to 12 companies, and 2 of them I owned. So. I don't stick rigidly to the PEG. It's just an indication, really, for me, that does it appear to be growing faster than its PE? I mean, that's really what you're looking at. So that's what you're looking for,
yeah. And you see if there's any value there, because it might be potentially undervalued.
So it's a value indicator. It's not. If I had to take one thing out permanently from this checklist, it would be that. Because it's really not consistent with everything else that I've put in it. But it's just something that I still like to look at.
I like the measure of the PEG, actually. Always have. And it goes back to back in the day, historically. You and me are of a similar age now, right? Remember refs? The big
you look
refs
better
books
on it.
You used to get? The big refs book was always about PEG, wasn't it? Remember?
Yeah.
Oh, I used to love that. I used to sit there. It's not like big yellow pages, like pouring through it. And absolutely fantastic, man. I'm showing my age now.
Yes.
Now, you mentioned
it's brilliant, though. It's all we had at the time.
Absolutely. We had to use what we had, mate, and no internet, to just crunch numbers, to do all the filtering for us. You mentioned in September that you saw the opportunities, saw what was going on with trusts, and you saw the LDI scandals that were going on and debacle, all that going on. And lots of really good stocks are being thrown out the market. And you touched on the fact that you had 2 takeovers. Tell us about some of the stocks you'd be like, I've had enough now. I'm going to restructure my portfolio. I'm going to get rid of some of these stocks. I'm going to purchase some of these. Tell us about some of the ones that you bought and why you were like filtered down to those handful that you went, right, I'm going in there. What were they? Why?
So, first of all, the stuff that I sold, it was it was all the sort of the alternative REITs, really.
Yeah.
So
And renewables.
I sold 4 renewable energy trusts that I had. I sold the digital infrastructure, DGI 9, and I had 5 property REITs, and I sold 2 of those. So I've still got 3 property REITs, which I'm happy to hold. They're my highest conviction ones, shall we say. And then what did I buy? Well, let's have a quick look. Sorry, I've got another screen up here with my current holdings, so I'm looking away. Well, the 2 that got taken over, or were takeover issues came up in last week, were K3 Capital and Crestchic. So K3C and Load. Yep. Yeah, well, Load. So Crestchic. I made about 50% on that, so that was very nice.
Brilliant.
K3 Capital, not as good, and I sold in the market. I didn't like some of the language around that particular offer. It looked like they had put themselves up for sale, which why? I mean, I couldn't see why they were doing what they were doing. Anyway, I was just a bit uncomfortable that actually, this offer might go through. So I exited in the market. And so people that have stayed in or even bought more, if they do get that takeover at 350 pence, then they'll have made. But my exit was around about 20%. I came away with, so that was okay. And I was one of the other reasons I sold in the market is because there was another one that I wanted to buy. That I thought, well, I've got something to do with the money, so I will take the cash now, please.
Let me just interrupt you for a second. The K3C bid, it almost reads, and I've written about this before, almost reads like a take under. Yeah. And I think anyone that's sold with the presumption that it gets taken out at 350, yeah, if they've sold it at 320, 328, whatever, in the past few days, there's that tiny little margin of what amounts to less than 5%, right, left to the market. If they come back and say, actually, for whatever reason, the larger shareholders, right, don't agree with the board and don't want to sell this at 350, I think it could go back below £3. Yeah. So you're risking a tiny 5% ish for a potentially 10% fall.
Yeah, well, there were a few things about that.
I think what you've done there is quite a smart move, taking the middle ground.
Maybe. I mean, I exited Crestchic in the market, but that was, I think that the offer price 401 pence, and I was getting 397. So I was happy to take that in the market for exactly the reasons you state. The gap with K3 Capital was a bit wider, and I hesitated for overnight on that. I almost pulled the trigger on the day it was announced, and I had a closer look at it overnight because I think it's a tricky one. It just didn't read right to me. There's something, sometimes certain things don't smell right. Well, the other bidders that were involved are no longer interested. They've pulled out. So you've got one bidder. You haven't got a confirmed bid. You're announcing the price you're hoping the bid's going to come in at. So there's obviously an indicative price. And it just didn't look watertight to me. It still looks like they were trying to sell it to the party that's still in. And I mean, it may well go through. The larger shareholders may well see it through. I don't think it's a great price. I think I can see what the directors are doing. I think it probably works for them more than shareholders would be my take on it. But I just looked at it and it just didn't smell right to me. And I look, let's just walk away from this. It's 20% in 6 weeks is fine. And I've got other things to put the money into.
Yeah, it's important. This goes with experience now. You're talking about being in the market since 1997. You've read loads of RNSs. right?
Mm.
And you're looking at the detail of the RNSs, not just the headline. This is the figure that it's being sold at, or potentially going to be bid at. You're looking at the language that's being used in the text of the RNS, and you're saying that's a bit of an amber flag. That's a bit of an amber flag,
Mm.
and you're going, For the newbies, all they're seeing is that it's recommended bid. Oh, happy Lula. And then, a few days later, they've seen the share price drifting, and they're wondering why. And they're posing questions to you in DMs, and they're posing questions to me and Wheelie in DMs, going, "What's going on?" Or posing it openly on Twitter, "What's going on?" And this is the beauty of reading and learning and gathering all that experience, that bank of knowledge. It enables you to actually question the realities of what's being said versus what's being done.
Mm-hmm.
You know what I mean?
Yeah.
And we see it so often,
Well, I also looked at it and thought, well, if that's the price that the directors are happy with, and that's what they think the company is worth right now, then I also have to hold my hands up and say I might have got my due diligence wrong myself. My own research. Things might not be as rosy for this company as I thought they were. Well, I mean, they might well be, but it raised enough questions, and I think amber flags is exactly that. There wasn't a red flag there. That's why I had to think about it, because, or I took some time to think about it, because there were, like you say, just a couple of amber flags, but sometimes that's enough.
That's enough.
Yeah,
absolutely. Okay, so got those two takeovers. You bought some more other stocks as well. Do you want to tell us a bit more about some of those?
So stuff that I bought. So I'm just looking at the stuff that I bought during that period, during the autumn, really. Argentex was one, which is flying at the moment. I mean, I think, I'm not sure I would be a buyer, but it was right now. But when it was sub £1, I thought that was really good value, and it, here we are, sort of 35% higher. FDM, well, actually, FDM I bought in August, before the sell-off, and I think I wrote in my Q3 review, I couldn't have got it much worse. That I thought I was buying FDM at a good price in the 700s. And it went down below 600, I think, in that period with the trust period. And I don't normally do this. When I lose 25-30% on a holding, I generally exit, unless, because it was market oriented, because it went down so much so quickly, because it was the market rather than company specific. I averaged down quite heavily on that, so I pretty much doubled my holding when it had fallen, and now already that's back in profit. So that was quite a good one. I bought Foresight Group, the asset manager in renewal, predominantly alternative asset manager. Has also terrific interims last week, or the week before last, and re-rated quite heavily. So that's already re-rated. I bought Goodwin, which is slightly different. I mean, there are no forecasts in the market with Goodwin, but that's there's some interesting stuff happening under the bonnet there. They've invested in a lot of areas to move away from the oil and gas dependency, and I think those investments are starting to come through now. So in terms of figures, the interims are due imminently, so by the time people are listening to this, I think the interims will be tomorrow. So let's see, but that's an acquired taste, I think. I mean, that's probably one that's slightly outside of my norm. And I'm looking at what else I bought during that period. I bought War Paint during that period, W7L.
War Paint,
Wilmington I bought during that period. But I actually spent more time, I think, buying more of the stuff I already owned. So I bought more Money Supermarket. I bought more, let me just see, Me International. I bought, I topped up quite heavily Me International, which is my largest holding, by the way. I bought, what else did I buy during that period? Yeah. Anyway, so I think I added to things like Bioventix, Spectra Systems. I added. So yeah, I was as much as buying new stuff. There were sort of half a dozen or so that I bought new, but it was as much about buying more of what I already owned, including, by the way, I forgot to mention, I bought quite a lot more of Impax, which I've held for a long time, and I had top sliced a while back and didn't think I'd buy back again, but they went so low that I bought quite a lot more of those.
Yeah, they had a bit of a dip, didn't they? And the market just went
big dip. I mean,
it was almost around the same time as the renewables are being sold off. Now, Simon, I want to go back and touch on a couple. I wanted to ask you this question because there's been lots of talk on and off Twitter and social media regarding Argentex, and I'm trying to get my head around why it's done so well, right? Of late, it's a foreign exchange provider essentially. And the markets regarding FX has been volatile for all manner of different currencies. And they came out and essentially said, we're ahead of current market expectations. Why have they done so well? And is it a good management team? Is it because everyone's selling the currencies and going into dollars? What's going on there?
I think really what's happened is that currency has become a hot issue for people, and particularly their market, which is corporates and high net worth individuals. So I also hold the asset manager record, which is much more institutional focused.
Absolutely,
in the foreign exchange market.
They've done well as well.
They have done very well, yeah. But Argentex, so their market, particularly the corporate market, suddenly you've got FDs in various corporate organizations now thinking, well, this is an issue because the pound's weak, the dollar's strong, we need to have currency hedges in place. We need to be able to, and also I think stuff around the supply chains doesn't help the currency situation. So currency has been fairly volatile this year, I think.
Absolutely.
And I think that's still going to be volatile next year. I think, the dollar's still strong and still hurting a lot of businesses, I think. Dollar index 105 last time I looked last night, I think about 105. The pound's improved a bit against the dollar, but it's still only 122 or thereabouts. So yeah, I think currency is a hot issue for their clients. So, and then when you look at their clients, well, a lot of them rely on FX services with banks. And I don't think banks are proactively helping clients at the moment as much as, well, I think they're dinosaurs, aren't they? Banks are generally dinosaurs in this area.
They've got a technology strategy now, banks. Come on.
I'm sure they've got an internet strategy, yeah. And so Argentex
closing all the branches, yeah. Oh,
so as well as getting more business from existing clients because of the need, I think there's it's quite a good environment for winning new customers, I would suspect, and that's really what they're doing, is they're aiming to take business off of the banks. So there are a couple of other players in this space. There's Alpha FX and one other that also begins with A, whose name eludes me. But they're probably all able to take business from the banks at this juncture. Argentex didn't have a platform. It was very much a personal thing, and so that held them back before. They've invested in a platform. They got a new chief operations officer who's implementing that, who seems fairly switched on he seems to have a roadmap for the platform. They've just got a banking license in the Netherlands. They have applied for a banking license in Australia. So both of the Netherlands and Australia provide a growth opportunity, as well as the tailwind of customers having a need and customers looking for someone that can help them. So I think a lot of the bank's customers are what I would describe as disturbable at the moment, and they've got a fairly aggressive sales team. So I'm not sure it's a company that I will hold for a very long time. I don't know. It's not a sector. I think it's a sector that can go wrong. And I think you could easily see I think they've got a runway for growth, but as that matures, you could easily see a situation where FX becomes more stable and the growth comes out of a company like this. So, I mean, I'm happy with it at the moment, and I'm looking forward to the updated forecasts in January when they give another trading update. And let's see. I mean, I think for the next year, it looks like a good one. I think there's more upside to come. I think, although it might go down before it goes up, given how it's gone up so quickly. Well, it's gone up very rapidly. I'm not sure I'd be a buyer at 135 right now. Maybe around 120. It looks good value again.
No, I love the objectivity on that.
Whether you are an experienced or new investor, you know how valuable it is to conduct portfolio enhancing analysis and to have easy access to data that will give you the edge. As a Twin Peaks investing podcast listener, you can access an exceptional offer via SharePad from ShareScope, the UK's #1 investment data and analysis software for private investors and traders. This special Twin Peaks offer is available to new subscribers only, and you can subscribe using the promo code TWINPETES. The incredible and exclusive offer means that monthly subscribers will get their second month free, and annual subscribers will get their 13th month free. Sign up and subscribe to SharePad today using the Twin Peaks promo code, and you can save up to £69. Visit sharescope.co.uk/SharePad for further details and subscribe to the investing and trading analysis and data you need.
You also touched on the fact that you'd bought Goodwin, but you weren't quite sure about it. And obviously, regarding certain stocks like Goodwin, they're not necessarily cyclical, but they've got quite a lot of input costs, and they can vary quite a lot. It's hard to hedge some of those costs. So what were the drivers there? Were you using your criteria and filters for that one?
First of all, there's a certain poster on my Twitter timeline who mentions it almost daily, so it's hard to ignore because he's one of my favorite posters. I'm talking about Ron Boyd. And if he doesn't mention it directly, he'll talk about Stoke, which is where they're based.
Yes.
No, I mean, so I've held before, and I felt that I was maybe a little bit early before. I think it's one that you've just got to buy. It's a family-owned business. They're in the third, fourth generation of family running the business. I held it at the time when the new generation were just taking over. I didn't know how they were going to fare. There was, I thought, some headwinds out there as well. So for some of the areas they were involved in. So I can't remember why exactly at the moment, but it was just sometimes I have a bit of a clear out, and it was one that just felt not the right time to be holding it. But more recently, I mean, I've read through the last annual report, and I'm looking forward to the interims tomorrow. But a lot of those capital investments that they've made are starting to pay off. So, I mean, if you look, for example, at their long term, their 5-year return on capital, it's only 10%, and normally that doesn't excite me. But I think that figure could be going up a lot more over the next 5 years because, like I say, they've made a lot of capital investments. They're in to some areas where there are far fewer competitors. If you look at the size of some of their foundry and some of the work that they're bidding for, well, there's not many companies in the world that can bid for some of those contracts, and they've got some areas, and it's one of those that you really have to get under the bonnet and really understand each of the divisions and what the drivers are in each of the divisions, what capital has been invested for each of those divisions rather, and you know it's quite an unusual one, and there's no forecast in the market, so you have to create your own forecasts. They don't have any sort of broker forecasts or house broker forecasts. They just don't do them. So
Yeah.
it's one of those that I think if you're going to own it, and I learnt this previously, that it's one that really you just have to say, look, it's a family business. I'm going to treat it like a private holding. The other thing that actually has happened with them, which I think one thing that they used to pay a dividend, but they've always paid a dividend, but it used to be paid once a year. And they've just this year started paying an interim dividend and a final dividend. Makes it a little bit more holdable for me, that it gives you something back a couple of times a year rather than just once a year. But that's a minor point, really. It's just an unusual one for me, but it's one that I really think could be a good one over the next 3 to 5 years. I think those capital investments are going to start paying off. Well, I hope they are.
No, listen, I think it's a good company, a quality company that meets a lot of metrics. I think we've touched on there as well.
And I should also say
that over the next 3 to 5 years, it's that opportunity potential for growth. So you're looking at it and thinking, you know what, the margins here or the return on capex is quite slow or lower than it would be ordinarily for the stocks that I want. But you know what, this is going to go to 12, 14, 16, 18. So therefore, that share price is going to accelerate or go up over the next 3 to 5 years because of that. And additionally, I follow Ron Boyd as well. He's a really meticulous, deep researcher, almost to the point of you thinking, all right, mate, we know that now. we know that. And he'll go to the AGMs as well, and he'll ask tough questions to the CEO and CFOs. He wants to know that what he's invested in is actually doing what it said he was going to do, and the companies are still on track. And not a lot of people are going to go from wherever they live to travel to go to the AGMs and all the rest of it. Fortunately, I think he still lives near in and around Stoke. Is that correct? I'm not sure. So therefore,
I don't know.
Yeah, so he might be able to get to the AGMs a bit easier than most people. But I think it's important when you recognise that someone is a deep and quality and good researcher to take heed of what they're doing. Don't follow them blindly, but always look and read and find out the good people on Twitter that actually do deep research, know what they're talking about, and are able to be a little bit, picky about the stocks, and very selective in the sense of they'll stay in a small zone and just stay there regarding the particular stocks. So not a bad person to.
And I wasn't suggesting that he was ramping, by the way. I mean, I value his tweets. I think he, like you say, he's a great researcher. He knows what he owns very deeply, and he knows what he doesn't own quite deeply as well. Yes. I mean, he knows a lot about absolutely. A lot. So I'm a big fan. But I said it tongue in cheek. He keeps it on my radar, shall we say?
Yeah. No, cool. Listen, I'm conscious that we've been on here for a little while. I want to have a quick break here now, Simon, and I want to talk about the 2 charities that we're pushing this year. It's very important. We spoke about Pete earlier, and Pete chose a charity this year for the podcast for the Twin Peaks Challenge, and that was the Backup Trust, which supports and helps people with spinal disabilities. So the Backup Trust, as you will all know now, we're raising monies for that. We're currently of the £10,000 target that Pete put up, we've raised £2,664 thus far. So I'm hoping that it's Christmas, getting towards Christmas, that our listeners will find it within themselves to just donate a £5 or more betwixt now and the 31st of December. To support Pete's and the Twin Peaks charity to get beyond that, at least that 3,000 figure, so we can make a nice little donation to the Backup Trust. We've had some further people that have made some donations, and we've had, I think the name here is Kevin S1, the Backup Trust, and that was earlier today. And his words were, "Great work, guys. Look forward to my long drive on the weeks when I know I have your podcast to listen to. Always great ideas, and your differing views always make me chuckle. Merry Christmas, Kay." So thanks very much, Kevin. We had the Stock Taker 9. Merry Christmas, guys. Hope you feel better soon, really. Thanks for your podcast this year. the enthusiasm you show keeps me more determined to research those winning stocks. So thank you for that. Scrumpy, fantastic Scrumpy guy, he's been donating as well. Scrumpy 222 made a donation, so thank you, Scrumpy, for that. And Claudio H. Fox, a top-up contribution at Christmas. Great podcast, Peter and Peter. I'm often 1 or 2 weeks behind, but enjoy listening and learning from you guys. Happy to support the Backup Trust, and we'll do so again. And then we had Faisal as well on Twitter at Faisal3, I think it is on Twitter. Much respect to the Twin Peaks for the brilliant efforts. And we had Pats at Patsy at PATXI. So thank you, Pat. Small token in recognition for your most enjoyable podcast. And David Linden, happy to help a really worthwhile charity. The podcast is okay as well. Thank you, David, for your donation. So I'll talk a bit more about the Memphis one a little while later on. But thank you all for your contributions. It really means a lot to us that you support the charities that we are looking to help, just as a means of saying thank yous regarding what we're doing. So really, really appreciate that. Okay, so back to renewables, Simon.
Yes, sir.
You've still got a couple, but you've got rid of some. And there was that stuff going on in September where a lot of them were getting sold off. They were going from premium to discount to NAV. Which ones did you keep and why?
I haven't kept
I'm asking this question because I actually purchased one recently myself, which I'll share with you in a minute.
Sure. I didn't keep any of my renewables. I had four. And I think there's a couple of things. First of all, the interest rate issue with gilts going through the roof. That was the point that it took them from a premium to a discount.
Okay.
And I had intended to maybe just sell 2 of them and keep 2 of them. And then we had, leading up to the Hunt budget at the end of November, we had a lot of talk about an energy price cap. Energy price cap. Yeah. And they did put one in the end. And I didn't know how that would affect the renewables. And it's just one of those situations that, this was great for the first 9 months of this year. I've given back most of the profits that I've made on these capital. They have paid me a dividend. Let's just take the money now. And it's had its time. I'm a big fan of renewables. Well, let me rephrase that. I think renewables are a big part of the long-term solution for energy. We've probably got to move away from fossil fuels. I know it's a bit of a political hot potato and an emotional subject. I think we need nuclear as a baseload. So it's quite a complex area, but sometimes you've got to remember you're investing. It's not charity investing, right? We're investing to make money, and
absolutely,
for me, the investment thesis changed with renewables, given the uncertainty behind the energy price cap and so on. I'd also just bought Foresight Group, which was
Foresight, yeah.
But rather than, because I had held their Foresight Solar Fund, and I bought Foresight Group because, actually sometimes owning the asset manager is better than owning the asset.
Shrewd move, mate. I like that.
And I also own Impax, which runs Impax environmental markets. So I feel like I've got the exposure to renewables, but in a maybe a lower risk way, but perhaps a way that actually has got more growth. Because I think the problem with any of these assets is there's not a lot of growth. I mean, the assets, we can talk about how they're valued and the discounted cash flow method and what discount rate is used, and other assumptions that they make in their valuation, and they're all slightly different. So you have to really get under the bonnet and see what their valuation methods are for the NAV.
But also, Simon, you've got to look at what they're actually doing and how they're doing it, because all these different REITs are all different. All these different renewable companies are all doing things slightly different. Are they in storage? Are they in wind? Are they in? You've got to. Sometimes having the bigger overview and buying Impax or buying Foresight reduces all that noise, and you're looking at actually are the management company doing what they said they're going to do.
Exactly. Yeah. So that's where I've landed with that. They were, like I say, good for a while, and I liked the idea of owning them. It did make me feel quite good owning sort of renewables, and when they did fundraisers at a premium, or when you got a decent price on a fundraise, I participated in a fair few of them. But yeah, it's just a market, and so I left, and I don't see it. It's not compelling enough for me to get back into it. Like I say, I own the asset managers, and they're not compelling enough, because I think if you do buy them now, you're buying some good yields, and I think those yields are secure. I think if you're an income investor, I think the yields are secure. I think what's not going to happen is you're not going to get a lot of NAV growth, I think, at the moment. And they're not going to be able to, if they're trading at a discount, they won't be able to raise funds to buy new assets. So it was a much better play when they were trading at premiums, when they were able to raise funds.
I see what you mean.
So I sold all 4 renewables, and I had 5 REITs at the time. I sold 2 of those, and I sold DGI9, digital infrastructure. So I sold 6 holdings, and I pretty much replaced them with top ups to existing holdings and sort of 6 new holdings.
Yeah, brilliant. No, I had a nibble when all the noise was going on, and I was looking at all the different nuances regarding what was going on in the renewable space. Lots of them went from premium, as you say, down to discount, and we're paying a reasonable yield. And I was hoping that they would be able to maintain that. But what I did notice was that regardless of what any of these renewables are doing, they're all tarred with the same brush, and all the share prices just all drifted from premium down to discount. Some of them quite significantly, but were maintaining or weren't going to be affected by the windfall tax that potentially could occur. So I picked up Harmony Energy Income Trust, ticker symbol HEIT, just recently. So that's the one that I've got in that particular space. I've looked at Impax many times, and it's one of them that I've always admired. And in fact, if you look back historically, they were the first in that space. So the management has been around, and you look at their total returns over the past umpteen years, they have been one of the best. And Foresight not far behind either. So that's the one nibble I've had in that space at the moment that I'm really quite happy about, in the sense of long term, will they be able to do what they're doing? Battery storage, energy storage, we see what's going on. Everyone's like, fingers crossed we don't have too many blackouts, you know what I mean, going on over Christmas, when the energy stuff might be, everyone's off, everyone switches the kettle on, everyone puts the Christmas tree lights on.
I think the key to renewables does revolve around storage, because it's on a day-to-day basis, it's so unreliable. It's variable, right? So sometimes we have too much, and sometimes not enough. So storage is key, but the storage capacity we have at the moment is minimal.
Minimal.
Yeah,
absolutely.
And so the last one I sold actually was Gore Street Energy Storage Fund, which actually was trading at a 3% premium when I sold it. So it hadn't fallen to a discount. It had fallen, but not to a discount. And I think that's not affected by the energy price cap either, or the energy policy, because storage was exempt. And so, but then Foresight Solar wasn't. I mean, they had enough overseas exposure and storage exposure that the impact on them was minimal. I guess. I think with those types of things, you're generally you're generally investing in them for the yield. They're not growth companies that those assets are necessarily going to increase in value. If anything, the assets over time depreciate in value and have to be replaced. So they're really, I would say, solid dividend. If you're putting together a dividend portfolio, an income portfolio, I'd still have some of them as part of that income portfolio if that's my sole focus. But I'm and that was my plan for the first part of this year. Like I say, they just became a much less attractive investment come the gilt. Well, absolutely. It was the gilts going through the roof, and then the whole energy, the energy price cap and so on. So And
No.
I mean, REITs as well, the actual property ones. I think recession can affect REITs, but I've tried to sort of just stick with a couple that I know well, and I like. I think they're going to be less affected by recession, shall we say? And one of them is a real. They're going into it with quite a lot of cash, so they're going to be buying value in the property market, especially when these.
Yeah.
Well, the other thing is there's still these open-ended funds that invest in property, which is again proven to be another, something that shouldn't happen. It's the wrong vehicle to invest in property, because they're illiquid assets, and as soon as people want lots of withdrawals, then they have to gate the fund. So I much prefer to own property through an investment trust. I wouldn't touch property or any illiquid asset in an open-ended fund. And I mean, it's AEWU, by the way, AEWU UK I'm thinking of. They're actively buying off of those open-ended funds at the moment at discounted prices. So a real opportunistic value investor in the property space. But yeah, I mean, they're
Got to be shrewd, mate.
I've held on to them for now.
Right.
Yeah, again, I mean, if that sort of holds at these levels, as long as gilts don't go through the roof again. So as long as they don't get an interest rate crisis again, and I'm hoping we don't, then they should be fine, I think. So I'll probably carry on holding.
I think that's a really good point there, to be opportunistic. And you touched on sometimes having to shuffle some of your stocks to create cash to make a purchase. But I think having the watch list, sometimes you can put them there until the cash comes to your portfolio. You've got a reasonable yielding portfolio as well. So that creates a cash. So you can start buying your starter positions in those stocks in your watch list that reach the top to the buy criteria. So it's nice to have that. Right, I'm conscious of the time, so I'm going to just share one research suggestion and then talk about Memphis a little bit. And a lot of you will know, rightly or wrongly, that I do like, particularly this time of year or any time of year, a nice drink every now and then. So I'm going to mention this stock here, and some of you guys, ladies and gents, will recognize some of the brands that this company holds. So Remy Cointreau, Metaxa, Mount Gay rum, the botanist gin, etc. I'm talking about Remy Cointreau, CAC 60 component stock, ticker symbol RCO, market cap just over 8 billion euros. And they came out with their half-year results back in November, and essentially another fantastic year where they showed their margins, and you'll like this, Simon, of 25.5%. Yeah, return on capital employed of 22.2%. And share price is middling at the moment, and they've done reasonably well. And starting to do, and you'll love this other bit as well, is that they're actually achieving quite a lot of group sales via e-commerce. So they're not actually having to be in retail stores. They're doing a lot of sales via e-commerce. So yeah, so I'm not going to go into too much detail because I'm conscious of time here. But as a research idea, and it's not just a seasonal thing, some of us just drink all year round for our sins. Go and have a little research and have a little push and a probe at Remy Cointreau, French listed company, ticker symbol RCO. Right. Last thing I'm going to do here, Simon, and I'll come back to you in a second. I'm going to just quickly read out some of the people that have made donations to the Memphis Christmas list. And I want to thank everyone that's done that as well. We've raised over halfway of the 22k. We've got until the 23rd really to get the presents bought and delivered before Christmas Day, essentially, at Memphis. So we're at 11,327 when I last looked. The target was for £22,500 because we're trying to deliver presents to around 1,500 disabled young children in and around Leicestershire and Rutland and so on and so forth. And I had a fantastic tweet. Thank ever so much to to Mike Ridyard at Ridyard Mike, who put a tweet out trying to push and encourage people to donate a £5 to the Memphis Christmas list. And he's just donated another amount to the Christmas list, and he's put great work done by Peter Higgins for the FinTwin community and various charities. And this is a little gift to show our appreciation. We've also had a donation from the secret accountant, who was the last guest we had on the show prior to Simon here today. Great cause, made a donation. Penny for the two of them made a donation, so thank you, Penny. Just somebody that put a podcast listener made a donation as well. At N2 Investor made a donation and wrote, well done, keep up the good work with both the podcast and fundraising. We had Midlife Investor made a donation as well. A worthy cause, Pete, thanks for the podcast. We had Claudio H. Fox, TPI podcast listener. My wife and I are spreading our charity donations to many charities which are struggling. However, Memphis touches our heart due to my work and experience with children with special needs. And again, Scrumpy made a nice donation as well. Scrumpy 222 has made multiple donations across Memphis and across the backup trust. So for all of those that have appreciated the podcast year to date, really thank you for making donations. For those of you that haven't yet, the account can be found for the backup trust at justgiving.com fundraising Twin Peaks, and for the Memphis one, it is again justgiving/fundraising Memphis Christmas List 2022. And I really appreciate any donations you can make prior to the 31st of December for both of those. Now, Simon, thank you ever so much for being on here. You've been absolutely phenomenal. Thank you for coming in at such short notice as well, mate. Maybe it's a nice break from the two grandchildren running you ragged. I don't know.
Well, I might have been shooting from the hip a bit because it was all very short notice, like you say. But I hope I've done you proud, and I hope I've done Pete proud. Mate, so, get well soon, Pete. We are thinking of you, and it'd be good to have you back on the next one.
Absolutely. I'm hoping Pete will be back. We'll be speaking again tonight after. He'll be because he wants to know who's going to be on, because I haven't told him.
Oh, you get a nasty surprise.
I did tell him we were recording it this morning, but mate, you've been phenomenal. You shared some really great insights, some fantastic companies, and I think the thing I want to say is the fact that one of the things I've admired about you is the consistency on Twitter, objectivity on Twitter. You share your blogs, you share the profit warnings, you share the successes, and you've been here throughout the good, the bad, and indifferent. Some people have been on Twitter, have disappeared. Some people have said, I'm not writing a blog anymore. And it's like, this is the good stuff that's happened to me. This is the bad stuff. This is all of it you've shared. And that to me shows a level of integrity that to your followers on Twitter, of which there's loads. And I'm hoping that being on here, other people will recognize that as well. And you'll get some more followers, but get towards the quality end of investing, not the speculative nonsense. And you are one of those individuals that invest in quality stocks. And we want more people to be invested long-term in quality stocks, not speculating with 95% of the portfolio. Speculate with 5%, 10%, fine. Speculate with money that you can afford to lose. But the long-term value of quality compounding is a term that you've used, is vital for the longevity of anyone's portfolio so they can meet the goals. And that's what you did brilliantly. So I will always be calling you the brilliant leader, but referencing it to investing. Lead the way, Simon.
Okay. Thank you for that, Peter. I appreciate it.
All right. This will be going out on Friday, hopefully. When you've listened to this, please share your feedback. We've had some fantastic feedback for the last podcast. Please give some love to Simon at Brilliant Leader on Twitter. Send your love and prayers to Wheelie when you're on Twitter. And support the charities, and hopefully we'll be putting out a late podcast in 2 weeks' time ish or thereabouts as a last and final sort of podcast. Wish you all as investors a happy Christmas, because this will be out during that time as well. And stay safe and stay blessed, and show some love to Simon when you find him on Twitter.
Mm-hmm.
Take care, everyone.
Thank you.
Take care, Simon.
Cheers. Thank you, Peter. Happy Christmas, everyone.
This Twin Peaks Investing podcast is brought to you in association with SharePad from ShareScope, the UK's #1 investment data and analysis software for private investors and traders. Visit sharescope.co.uk and discover the advantage.